Silver is no longer trading as a single global market. Right now, the same ounce of silver carries three different prices, depending on the exchange. On Shanghai's SHFE, silver futures are already near $80. On India's MCX, they are close to 78. On COMEX in New York, they're still around $72. These are all futures prices, the same metal priced under different market conditions. That $6 to $8 gap is not a temporary arbitrage issue. It's a structural divergence. And today, using actual exchange data, I want to show you what's happening in Shanghai, MCX, and COMEX, and why this divergence is a clear signal of stress beneath the surface. Let's start with Shanghai Futures Exchange, SHFE. Shanghai silver futures are already trading near $80, but price alone is not the key signal here. Let's take a look at the Shanghai warehouse stock chart. This chart shows silver warehouse inventories held against the SHFE contracts. Notice the clear sustained downtrend starting February 2025. When warehouse stocks fall, it means physical silver is leaving the system. Actual metal is being withdrawn, delivered out. At the same time, price is rising. That combination tells us something very important. In Shanghai, price is driven by physical demand, not leveraged speculation. This is what a tight market looks like. Inventories fall, price rises, futures reflect real-world scarcity. Shanghai is not anticipating scarcity. Shanghai is already experiencing it. Now let's move to India's MCX. India is one of the world's largest importers of silver. That means MCX prices don't just reflect paper expectations, they reflect replacement cost. In simple terms, if silver becomes harder or more expensive to source globally, MCX feels it first. Let's look at MCX silver futures data. The prices are in rupees per kilogram. If you focus on March and May 2026 contracts, March is trading around 219,000 rupees per kilogram. May is closer to 224,000 rupees per kilogram. Now here's the key detail. Current spot MCX prices are already trading at March forward levels. Current MCX futures prices are trading at May 2026 clearing prices around the 224,000 rupees per kilogram. That tells us something very clear. Indian traders are not expecting silver prices to fall back down. They're already pricing future supply at today's elevated replacement cost. This is not speculative enthusiasm. MCX is behaving like a physical procurement market, not a leveraged paper market. Now let's go to COMEX. This is where most people expect price discovery to happen. Silver has moved above $70. And as that happened, something very specific showed up in the data. On screen, you're looking at COMEX silver volume and open interest. Here's the key observation. Open interest is falling even as price is rising. On 23rd December, silver's futures open interest dropped by roughly 1,000 contracts. Silver options open interest collapsed by over 50,000 contracts. This combination is critical. If traders were confident opening new short positions above $70, open interest would be rising. But it is not. Instead, positions are being reduced. That tells us existing shorts are being closed, not replaced. Now let's look underneath the surface. You'll notice increased activity in TAS, trade at settlement. TAS is typically used when traders want to exit or roll exposure quietly without taking fresh directional risk. You're also seeing EFP, Exchange for Physical Activity. EFP allows paper positions to be shifted off COMEX into private or offshore arrangements. And finally, notice PNT, privately negotiated trades volume, clustered around March and May. This is not aggressive positioning, this is risk management behavior. When markets are healthy, price rises and open interest rises. When markets are stressed, price rises while open interest falls. because participants are reducing exposure, not adding leverage. COMEX right now is showing the second pattern. Now let's put all three markets together. Shanghai, physical inventories falling, prices rising, metal leaving warehouses. MCX, forward prices elevated, spot already near future replacement cost, import market pricing scarcity. COMEX, price rising, open interest falling, shorts reducing exposure. Same metal, three different behaviors. This tells us something very important. The physical markets are leading, the paper market is adjusting. COMEX is not breaking yet, but it is losing control of price discovery. And historically, when that happens, price doesn't drift higher gradually, it reprices. Silver is not just moving higher, it is splitting into three markets, one driven by physical drawdown, one driven by replacement cost, and one driven by paper stress. Divergence like this don't last forever. Eventually, paper has to reconcile with metal. And when it does, the adjustment is usually fast, not polite. That's the signal embedded in the data right now. If this helped you understand what's happening beneath the price, like, share, and subscribe. You're watching MarketVelugu Light on Markets. More importantly, keep watching the structure, not the headlines. I'll see you in the next one.